Hi folks, this is Craig the Options Linebacker. This is the weekend report for Sunday, May 30th. I think the big question on everybody's minds right now with the recent fear and downside we've seen in the market is, are we still in a bear market? So to answer that, I'm going to go through a few different monthly charts of the indices that we follow. We'll start out with the SPX. Now the SPX, or the S&P 500, went from a higher high to a lower low through this bear market from 2007 to 2009. And since then, we've gone on an 83% rally up to just shy of the 61.8% retracement. Now, technically, you could say that this is just a bear market rally since we did go from a higher high to a lower low. What makes me think that this is not just a bear market rally right now is the fact that it was 14 months long and such a big rally off of the bottom. I think in the bigger picture, if you look back in the last 10 years, you can see that we're just in an enormous trading range. So within that trading range, we're going to see bull markets and bear markets as well. Now, historically, bear markets usually last about 18 months or so, and you can see that the ones that we had from 2000 to 2003, this one's a little bit extended, but is pretty well in check. And we had a real serious one recently. That one played out. That was about 18 months as well, too. And it looks like so far we're just in another bull market so far, although we've had a first shot over the bow. I'll have more to say on this chart in a minute, but let's look at some other ones. Here we see the NASDAQ monthly chart, and after the bubble that we had going into year 2000, you can see that this is obviously corrected and is going through just a sideways consolidation pattern. So even the bear market that we had here, when you put it in this context, it doesn't really look all that bad. And we're certainly not in a bear market per se right now in the NASDAQ. The NASDAQ is actually making higher lows, higher highs, and so far we're just seeing a sideways pattern. What's important to me about the NASDAQ is that sure, we got some valuations way out of whack back here in the 90s, but the NASDAQ and small caps, as we'll see in just a second here, have really been the engine of growth over the last 10 years. Now, here's the Russell 2000, the small cap stock. So we have 2,000 small cap stocks in this index. And going all the way back to 1995 here, all the way through this chart, there have been higher lows and higher highs all the way along. So you really can't say that this chart right now is in a bear market. Even the fact that we've gone well above that 61.8% retracement of the most recent bear. So again, guys, before I go any further, remember, I'm not a bull, I'm not a bear. I really could care less about either side here. I'm just looking at the chart and letting the chart tell me what to think. And right now, I can't see that the Russell 2000 is in a bear market. This is straight Dow theory, higher highs and higher lows. And now we have the same thing with the transports. The transports, the same deal here. Even though we've gone through a couple of bear markets, you can see, and this one was most severe, what's important is that this didn't make a lower low and is above the 61.8% retracement of this move, indicating that the probabilities have improved for a retest of at least the top. So just looking at this chart, if you didn't know any better, if nobody told you what this chart was, didn't tell you what duration it was or anything like that, I think you'd be really hard pressed to say that this chart, the transports, is in a bear market right now. All right, let's move in on time frames now. Let's go to the weekly chart on the S&P 500. You can see this beautiful 5-wave swing to the upside. We've moved down now. Now this could be the A wave of an ABC correction, or it could be wave 1 of a topping pattern. So we could be going wave 1, wave 2, and then wave 3 kicks in and takes us down to whatever the bear's forecast is this week, which is probably around S&P 100. Now, what I would contend, and I've been talking about this now for as long as we've been dropping like a stone here, which is, it seems like months, but it's only been about 3-4 weeks now. And what I would contend is that we don't have to jump the gun here. If we're truly rolling over into a double dip, if we're going back down to S&P 600, it's not going to happen next week. We're not going to miss out on the move. We don't have to cheat the move. This is just the first wave. Now, what always happens with these, and I'll show this in a minute, is that there's always a lower high that sets up on the weekly chart before things really fall apart. And then this is what happens is that then you start printing waves to the downside, and they can be fast, sure, as we've seen here, but look how long it took before things really fell apart. Now, for the past few months on the S&P 500, I've been using the 2007 analog because this has been so close to what we've seen. We had a very strong run-up at the end of 2006, early 2007. Then we had a quick little shot over the bow, which was very similar to what we saw this year in January. And then look at this. We had the final wave higher, which was very strong. So in the spring of 2007, we had this monster rally that came out of nowhere. And then what happened is we got into the July time frame. Wow, things just fell apart. This is when the subprime first hit our radar. Although you can see it started to hit the radar here with some of the carry trades that we had with Japan, but the first subprime really hit in the summer of 2007. What happened after that? You have to go back 3 years to remember how scary and how fast that drop was. But what happened right after that? We rallied to new highs. It usually happens, guys. Just when everybody was absolutely bearish down here, what do you think the Fed did? The Fed started cutting the discount rate window. The first time in years. In fact, this was all a rising rate environment all the way up to this point. The Fed, and they actually did it on an options expiration Friday in the middle of August, and completely blew up the market on that particular day. And we had just a big time rally for the next month or two that led us to new highs in the S&P. You'd have to go through this again to feel how bearish things were back here and how just miserable everything was, as everybody was convinced that with all the subprime things that we were heading into a bear market, but they all got run over in the next 2 months as the market went and printed new highs. Just when everybody got to be bullish again, the market pulled out the trapdoor and we started making lower highs and lower lows, and it was all over from there. Now let's go into the daily chart on the S&P 500. What I don't like seeing here is that it does look like we have a broadening pattern setting up on the S&P. We could certainly see this on the weekly chart as well too. The volatility is increasing, and normally that's a bearish pattern as the prices are making higher highs and higher lows. And on the daily chart, we're certainly making lower lows, lower highs, lower lows, lower highs, and it seems to be winding to the downside. However, we've not been able to establish closing lows much below about S&P 1060. So this is where you see all these big shadows to the downside. These tails on these daily candles show that somebody is, first of all, you have bears washing out and taking profits as you get down in this area, and then somebody stepping in and buying as well too. That's why we have such big volume down here at the bottom. So the daily chart is starting to support the probability that we may see a quick spike higher at this point. Now, what's going to be interesting over the next few weeks is whether or not this rally, this relief rally, when it comes, and it will come because all descending channels will eventually break to the upside. But what will be interesting to see is how high this can get. Whether or not it makes a lower high, and in that case we're heading for a C wave down or perhaps even a wave 3 to the downside. So look out for that one. But we could make a higher high from here. The key before all that starts is we're going to have a big scary day to the downside most likely, which is going to get all the weekend bears to jump on again, and then there's got to be some buying to get it above and beyond this descending trend line, and then the fireworks should start. Our June condor positions are still hanging in there with a great one at the top, a little bit tight on the bottom, and we have a nice one also on the IWM. We're also in a current swing trade, which is a short on the SSO or a long trade on the SDS. We shorted at this level. We're still holding the position and trailing it on the 21 period moving average. Have a great holiday weekend, folks. We'll see you next week.